So for years, multiple years, my portfolio has outperformed the S&P 500 benchmark, and let me tell you, it's not because I'm some sort of rocket science genius with a very sophisticated plan, but rather because I follow these 6 rules that I'm gonna go ahead and share with you in this video that are very simple yet powerful for you to follow along. This way, when you go ahead and put capital into the market, it doesn't feel like you're just burning your money, because of course, you work hard for your money, you want it to work just as hard for you, if not harder. So let's go ahead and delve into it. Starting with rule number 1, which is very simple, and the key is to identify the trend of the market. Before you open any position, you have to understand, well, what is the directional move of the market? If you mess this up, you're gonna mess everything else up, right? Because again, if the market is heading up and you're shorting the market, well, the odds are against you. And vice versa, if the market's falling down and you're bullish, again, the odds are against you. So what are a few ways you could easily identify the trend? Well, here's one of them, which is a fundamental perspective, and that is simply keeping an eye on the growth of a company. For example, if a company is reporting increasing revenues and profits, that's a sign that things are likely going to go ahead and push upwards. And of course, vice versa, if you see earnings and revenues trending downwards and actually falling down, well, that is a pretty bearish indicator to kind of understand the directional move of a particular security. But of course, you could also take a technical stance on this as well. Is a particular stock or security holding above its 50-day moving average or 200-day moving average? Is it pushing upwards? If so, then that's pretty bullish. However, of course, if it's falling below, breaking below the 200-day, the 50-day, whatever moving average you're looking at, well, then that's pretty bearish, and that's a sign that the trend is moving downwards. But of course, you could dive deeper and even look at pretty much the macroeconomic landscape and look at factors like what are the interest rates that are being set by the Federal Reserve, because of course, this could influence what type of environment that we're in. Rising rates typically mean that we're in a tightening market cycle, versus rate cuts means that we're kind of in this expansionary period where we can see businesses invest and grow. And so that's, of course, something you also want to look at if you want to look at it through the lens of a macro perspective. Now, me personally, I like to use a confluence of different data points to kind of identify what the trend is. However, for yourself, you can choose to just follow one. You could just look at the trend from a technical stance, fundamental stance, or even just look at alternative data. You just have to choose whichever stance you want to look at to go ahead and help you identify what the trend of the market is. Now, the second rule to dominate the market is very simple, again, because none of this is complex, and that's simply to go ahead and develop a plan. And so developing a plan is very similar to planning a trip, right? Imagine you're heading out to a new country without a map or even some itinerary, right? You'd probably waste a lot of time, you'd probably get frustrated, and you probably would miss out on the best experiences. And so one aspect of cultivating a plan is highlighting what your market focus is, and I recommend that you don't focus on all these different sectors, but really just choose a few sectors to keep an eyeball on. And that's simply because when you're buying and you're selling, you have to understand that you're buying and selling into different operations, right? Each business or operation is going to be completely different from one or another, right? For example, think about Hershey's, right? When you think about Hershey, I think you're probably thinking about chocolate, right? That's one of their main products. And of course, they sell a whole bunch of other different products, but think about, okay, chocolate. Well, if you're looking at Hershey's, what should you be gauging? Well, you should probably gauge with the weather in, I believe, West Africa and Ghana, where 1/3 of the cocoa production is made, and you want to keep an eye on what the price of cocoa is, because of course, if the price of cocoa starts going high because of droughts and, cocoa can't just be grown, and however they refine it so that Hershey's ends up getting the ingredient that they need, you want to be aware of all that, because that could severely impact the business operations. Another example is looking at like an automaker, right? Think about Tesla. It could be any automaker, right? Understand what's going on with their factories. Are they building new factories? Are they having any issues with their factories? Are we having any improvements so that this way we could improve the margins for the business? I mean, it really depends on what sectors you're looking at, and that's why I really strongly recommend that you only focus on a few different sectors, because if you're all over the place, then you're definitely going to get crushed. And I think that's why so many people end up underperforming the S&P 500. And at that point, you might as well just buy the S&P 500 and hold passively. And of course, if that's what you want to do, then by all means. But if you want to go ahead and dominate the market and outperform, then you're going to want to go ahead and have a hyper focus on a few different businesses or operations that you completely understand. Same thing with futures, right? Even if you're not trading stocks and you're trading futures, or let's say you're trading crypto, right? But let's stick to that example of futures, and you're trading cattle futures. Well, you better understand how the operation of farmland and how cattle futures actually increases with the supply and demand actually works. And this works for any market. Again, it doesn't matter if it's even, looking at currencies, right? Like Forex, foreign exchange. You want to understand, well, what makes the dollar go up? What makes the dollar go down? Then you'll probably want to look into tariffs. And so that's why you want to have a major focus. This way you could keep an eye on the components that are going to have a huge influence on the operations. But of course, another aspect in regards to cultivating a plan is figuring out what aggregate time period are you going to be primarily focusing on. Are you going to be looking at things from an intraday perspective, or are you going to be taking a look at things from a larger time frame where you're building positions from a few days to a few weeks to even a few months? And so that's something else that you want to be mindful of. Now, I recommend that you don't only primarily focus on day trading or doing intraday trades, simply because a majority of market participants who only focus on the intraday trades end up losing over the long run. You're better off focusing on a larger picture, but again, to each your own. And of course, the idea is just figuring out which one you want to choose. But of course, you can do a mixture, right? For example, you could be someone who primarily focuses on the larger time frame, but every now and then have an intraday trade. But you want to figure out where you're going to put your primary focus on. Again, a quick tip or recommendation from myself is don't focus too much on the intraday, but that's just my opinion. You are free to select whatever you see value in. Now, the third rule to dominate the market is mastering risk management. And I want you to think of it like the seatbelt to your trading plan. It doesn't stop accidents from happening, but it ensures that they don't destroy you. Because no matter how great your strategy is, losses are inevitable. But the main difference between a market expert who is successful and a market novice who is going to fail is making sure that when you're participating in a market, you don't have a position that's going to get easily wiped out where you're just gone and you can't participate further. The name of the game is safety and staying in line to make sure that you could go ahead and participate and win for the next day. Very similar to the concept of having a seatbelt, right? You don't have the right protection, that may be your last time on the road. And I hate to make it very grim, but that's the idea. You want to make sure that you have protection, and that's why you really want to focus on risk management. This is probably one of the main tenets of the rules that I'm sharing. Now, in regards to risk management, we could go ahead and delve into the concept of position sizing, risk to reward ratios, and just overall discipline. However, that would make this video much longer than it really needs to be. But if you're interested in having a solid idea of risk management, make sure to check out the links in the description below, because one of the links is going to be a link to join the Push and Profit private group, where you have access to my lesson library, where I very clearly break down a good strategy for risk management. And I also have my daily briefings where I talk about what's going on in the markets, and I occasionally mention topics like risk management. But if you're interested in getting a better idea, make sure to click out the links in the description below. This way you have that access to the lesson library, because having a conversation about risk management could go on for days, and I really don't want to take up too much of your precious time. So let's go ahead and talk about the next rule. And so the fourth rule to dominate the market is to focus on indicators, but this time it's not about spotting trends, it's about using indicators to refine your decisions, validating your setups, and uncover the best opportunities. For example, once you've identified the trend of a trade, indicators can act as a second layer of confirmation. For example, if you're looking to invest on a particular stock based on its PE ratio, you can combine it with volume trends or institutional buying activity. This way you could validate that others see value in this position as well. And so the purpose of indicators isn't to complicate your strategy, but to simplify decision making and give you confidence in your trades. Now moving on to rule number 5, that is executing and adjusting. See, having a plan is one thing, but executing it consistently is where most market participants fall short. And so once your criteria are met, you need to pull the trigger without hesitation. Overanalyzing or second guessing could pretty much lead to missed opportunities or worse, impulsive trades outside of your plan. And this is why you again want to identify your plan, going back to one of the previous rules. And so execution is about building good habits. Each trade you make should align with your plan. If you deviate even for what feels like a good reason, you pretty much risk undermining the entire system that you built. Which then brings us to the final rule, which is review performance. Now this is where you analyze how your plan, your strategy all has been working. And you could do this through a variety of different ways, simply by either journaling things, writing it down by hand. There's several different pieces of software where you could document this. And this is gonna help you identify whether your plan is actually a good one, or whether or not you're gonna have to go and restart going back to, square one or rule 1 and kind of adjust, everything else. This way you could make sure that you have a plan that is actually working. And so this is the final step to review. And if things are looking well, then don't change things, right? You shouldn't have to reinvent the wheel. If things are working, then you should not change what is going on. So just kind of wanted to share that with you, because these are the 6 rules that I leverage every single time I participate in the markets. Of course, I'm gonna have those losses, those small little losses, but then that again goes back to the idea of risk management, and that helps me actually be able to reduce the risk of kind of blowing out a portfolio. You should not be blowing out your portfolio when you're performing in the markets. If you're doing that, you're doing something completely wrong, and you're gonna need to, again, on the last step, review your performance and change a couple of things, right? Because you should either lose a small amount, this kind of goes back to risk management, lose a small amount, win, or break even, right? For each trade. And you want to make sure that the probabilities are in your favor. And so once you have this all together, this is going to help you actually have multiple years, row after row or year after year, where you're outperforming the market. And again, you don't have to be a rocket science genius to go ahead and come up with a plan like this. It's not that sophisticated. As I broke down, these are the few steps that you just need to follow along. With that said, if you're interested again in joining the Push and Profit private group, where I have my daily briefings, this way, if you're interested in how I break down the market, that's where I provide just my insight every single day the markets are open. Make sure to check out the links in the description below. And with that said, before you guys go, make sure to check out this video right over here, and I'll see you guys on that next video. Take care, guys.